Hey there, everybody. Hey there, hey there, hey there. Today is Thursday. That's right. It's Friday Eve. How could I forget that? For those of you, and I'm a little hyped up right now, for those of you in our GLD trade, okay, we just crushed GLD with a short position from yesterday. In fact, Charlie Moon and I were just saying, and I'm gonna change the screen here, guys. Can't remember gold moving this much in one day, let alone this dump to the downside. Let me pull in a different chart here for everybody to take a look at this real quick here. Hang on. Nope. Hang on. I'm just going to punch in GLD. There we go. Let's look at this chart. Let's put this on a minute chart. That is falling off a cliff. That is absolutely falling off a cliff there. What is like, here we go. Yeah, whoops, don't want, I am trying to get gold futures up here. Come on. There we go, GC. There we go. Look at that. Gold futures went from 40.30 to 39.76, a $60 drop, 1.5% there. In literally, is that a matter of minutes? Wow. Wow, wow, wow. So everybody that's here that was in our GLD position, FYI, you should be out of the entire position there. Both the call side, the put side, everything. You got it, Mike. Happy about that. Nicely done, everybody. All right. So here we are. Not only am I stoked, psyched, whatever the word is about GLD here, but obviously on the Cubs game last night, too. We'll get into that. But first, let's talk about risk tolerance, risk allocation. I get a lot of questions, and I think from many of you, get a lot of questions on how to calculate risk on a trade. It's obviously pretty easy to do that on a debit trade. But what about some of the credit trades, ratio trades? So I had to pull up because yesterday I used I used a picture from a board game Stratego. Today I used it from Risk. Okay. But risk tolerance is the degree of uncertainty and financial loss that you are willing to take in any investment. We always talk about it, obviously, in terms of our option strategies. Every single trade, no matter what, every single trade has some level of risk to it. And obviously, some level of reward to it. And it's our goal, my goal, to teach you and Mike Shore, and Charlie and Howard, and Dan, and everybody to teach you the proper reward to risk allocations. Because every trade you take is going to have some sort of risk to it. So when we're trading options and we're trading spreads, we need to look at debit versus credit spreads. Okay. And we know that it's pretty easy when we have a debit spread to understand the risk. Okay. So, in fact, what I'm going to do is I'm going to pull up our GLD position here. And now we had more to this position, but let's just look at the put side of this position, which was a debit put spread. Okay. The debit put spread could be worth $5. Okay. This is a long debit put spread. Could be worth $5. The only risk we have to this part of the trade was whatever we paid. Okay. So we paid a quarter. Now, I know that that was in conjunction with another part of the trade. Okay. So let's say we had paid, I'm just throwing this out there, $1.40. What could our risk be? That's it. That's it. If both options went out at expiration worthless, that's our risk, $1.40. Whether the GLD went to zero, which would have been a good thing because this was a bearish position, okay, where we would have made money, or even if it went to 400, 500, 1,000, whatever it is, what we paid the debit as part of the vertical spread, that is all we could lose. Now, we have this position now after a roll that we did, for those of you that are in OpVol, in a stock called PDD. Okay, this is not the position we started with. We actually started with a diagonal, which we just rolled into this position here. Okay, what is the most that we could potentially lose in this position, this calendar put spread that we have? What is the most we could potentially lose? What you paid for it. Excellent. That is the correct answer. Now, what did we originally pay for this position? I'm just going to put this up here right now as what we have right now. Our original position here, which was a diagonal, which I'll go into in a moment, was $1.25 was our investment. Now, we just took in 40 cents from a roll. So even if you don't have this position on, guys, don't worry about it. So 85 cents. Okay, 85 cents is our net for being in this position. We can't ever lose more than that. How would we lose? Well, if at the end of this calendar spread, when our long option, the October 31st 125 put expires, if both of these options had expired worthless, the one that expires next week on the 17th and then ours a few weeks later, if both of those were worth zero, we lose what we paid. We cannot lose more than that. Okay, so let's say that this was the original position we had put on, and we actually did pay 85 cents for this. Okay, thank you, Robert. Okay, now let's say you have a $10,000 account and you are allocating 3% of the risk of any one trade, okay, on any one particular spread. Knowing that 85 cents is the maximum you could lose, that is your risk, okay, how many of these would you have done? And yes, you need to remain constant. You need to use the same risk allocation on every trade. It is vital to understand your risk. So how many of these with a $10,000 account risking 3%, Okay. Well, Robert, we can't do 3.53 contracts, even though that is the exact right answer. So, yes, you would either do three or four. Dorothy, 100% correct. You would do three or four. Okay. Any questions on that? Does everybody understand how we got that allocation, understanding the risk on this spread? Okay, 30-year bond auction just went off. Looks to be right in line. I'm looking here. Looks to be a little bit better received than ones in the past here. Maybe we'll see bond markets rallying a little bit on that and rates coming down a little. Yes, Kevin, you're right. Jeff's after hours room goes into this. Okay, now let's change this up to the trade that we originally did here. We'll stick with PDD. Okay, this was our original trade. Okay, you'll notice this is a diagonal, not a calendar. Okay, same component, same concept as a calendar where we're buying time, but the strikes are different here. Okay, we paid $1.25 for this. That is the most we could lose here. That is the most we could lose. We can never lose more than that. So you would calculate your risk allocation based on, okay, I could lose $1.25 here on this spread. Does everybody understand that? Because I'm about to throw a monkey into the wrench, or a wrench into the monkey, or a monkey wrench into the explanation here. Whatever the saying might be. Okay, what if this position was opposite? What if this was the position? Okay, what if this was the position and we had, well, you know what? I'm not even going to do that right now because we're going to go into credit spreads in a moment here. Okay, now on a butterfly spread, and I'll put one up here that we have right now in STX. We have this position. Okay, we have this position. Good job there, Kevin Aaron. Nice job. We paid $1.60 for this position here. What is our maximum risk? What is our maximum risk? Exactly. It is what we pay for it. It is a debit spread here. It's what we pay for it. You would base your risk allocation on that. Now, what about, I am going to put up a position here opposite of what we did this morning. Okay, this is the iron condor position in CVNA that we put on this morning, but here I reversed it to reflect buying this. Okay, we actually sold it this morning, but this reflects buying this iron condor. What is our risk? What is our risk? Let's say we had paid, I know where it's trading right now. Let's say we paid $4.50. What is our risk on this iron condor? Okay, what we paid for it, $4.50. So again, on the debit side of things, it's usually not 100% of the time, but it is usually pretty cut and dried to what the risk is. Now, that's different. And this is what throws some confusion into, especially if you're starting out, you're a newer trader, if we have a credit spread. Before we go into some examples on the credit spreads, yes, today's word, jumbled word, is need to more. Need to more. That was me and my boys last night at Wrigley. And we are now saying we need to more. All right, love it coming through here. Late game tonight, by the way, 8 o'clock. 8 o'clock Central Time, Chicago time, which is great personally for me. I'm not going to the game because I'm doing a webinar tonight showing everybody my dedication. But thankfully, the webinar starts at 7, game starts at 8. Yeah, maybe I'm going to zip through my webinar a little bit quicker tonight than I normally would. But yes, the Yankees are out. Blue Jays are looking good. Otherwise, boy, if it weren't for that stinking thing called work, I'd be going to the game tonight. But it is all good. It is all good. All right. Credit spreads. Credit spreads. Thank you. Those are my 3 boys. Okay. Now, let's look at just a vertical spread. Okay, let's look at a vertical spread here. Okay, we have this position on an FIGR, but what if it was the opposite? How would we calculate what our risk is on something like this? Let's say we had sold this. Because remember, this is a credit spread. So we had sold this for $3. What would our risk be on that? Okay, 12 bucks. 12 bucks, 12 bucks, 12 bucks. Pretty cut and dried also, but it's different because we do have to look at what is the maximum value that this could be worth. Okay, 15, we collected 3, that leaves 12 bucks as our risk. Okay, now we're going to go into the calendar that we were just talking about. Okay, we're going to go into the calendar and the diagonal we were just talking about. So let's look at PDD. Actually, we can look at KMX too. KMX, we have a diagonal call spread on that we are long right now. Okay, we bought this thing, so we bought some time and we bought the lower strike option. We paid 175 for this. Okay, so buying it as a debit, that's our risk. What if we had sold this for 175? What if we had sold that for 175? What would our risk be on that, folks? Okay, AJ says 75. Robert says 175. Haven't seen the right answer yet. Elisa, that's a good answer. Need two more. McCarty, need two more. That's a good answer. We can't figure out what the risk is on this. We can't calculate that. Because what happens, and this is why a trade like this, your clearing firm, your brokerage firm would just charge you an inordinate amount of margin on this because of the risk. What happens if we get to October expiration and our 50 call that we own, which we believe is protection against the 47 and a half that we sold? What if that expires? What if the stock is 48, 49, 49.90 and our 50 call expires worthless? Now all of a sudden we are left with just a short option. We are left with a short call option. We don't know what the risk could be. It is not identifiable. It is potentially unlimited. Does everybody understand that? That is absolutely 100% accurate, Kevin. That is why we don't sell calendars or diagonals. As much as we may want to when there's an opportunity, if implied volatilities were out of whack for some reason, we don't do it because the clearing firm, your brokerage firm, treats this as if you have a naked option because the option you sold is longer out in time than the option you bought. Okay. All right. 1 minute till the wheel closes. Here is our phrase of the day. I'm not even going to call it word of the day. Our phrase of the day: need two more. Just as a reference here, not that anybody cares, but I'm going to say it anyway. That's my son, my youngest son, who just got married in Colorado last month. That's my oldest son, who just became a daddy and made me a pops. That's my middle son, who's probably not so far away from being engaged. And then there's the old man. All right. One more here. Let's go to our iron condor in CVNA that we have. Okay. We sold this Okay, this was a credit spread. Thank you, Robert. God bless. There's no question about that, Al. If there was one of the three that found himself in some hot water in places, oh yeah, it was very much him. Thank you, Ruben. Okay, we sold this for $4.50 credit. How do we identify the risk? Well, this one we can identify the risk. This one is risk defined because all the options expire within the same expiration. So there's no calendar, no diagonal. We happen to have two short spreads. That's fine. That's fine. The maximum this could ever be worth is the difference between the spread, the strikes in either the call spread or the put spread, which are both the same. They're both $7.50 wide. So pretty easy then when you break it down like that to see that our risk is $3. We don't have 450 risk there, Kevin. 450 is what we collected. So that leaves $3. The maximum value of what this could be less our credit. Steven, how was the game last night? You didn't give me opportunity yesterday when you told me when you were sitting. By the time I got to you to let you know where I was sitting, you were already gone and probably on your way. Definitely would have bought you a beer and maybe one of those Korean dogs that they were selling last night. I don't know if you saw that or not. $21 foot long Korean dog, which no, we did not indulge in. We definitely had our share of hot dogs, but Ross, we sold this. The credit was collected immediately when we put the trade on. Okay. We collected $4.50 this morning. It was the $21. Yes, that was, Jake. I wasn't touching that. You are welcome. So it always helps, guys, to just kind of refine our skills and go through some refreshers on how we calculate risk. Now, the Netflix trade that we tried to put on 2 days ago, which was a broken wing butterfly, but a short broken wing butterfly, which we put on for a credit, that's a whole different calculation. We can go into that another time. All right, everybody, I think we got the wheel ready to go here. We sure do. Another jam-packed wheel with the winner of the wheel going into the entry 3 weeks from tomorrow is Halloween, and that will be the entry into our Vegas wheel spin. Anybody out here actually signed up for Vegas or thinking about Vegas? All right. Kent, Kevin, we'd love for you to go. Justin's already in. Deb, way to go. Dorothy, Surya, beautiful. Steven, oh man, I hope your MRI is okay on whatever it is. Dusty, way to go. Remember, if you've already paid for Vegas and you happen to be the winner on October 31st, we'll give you your money back. All right, let's give this a whirl here. Love seeing all these names on here. Today's winner, a Gene, or a Gilbert. Who's it gonna be? Monaco. Gene Monaco. RJ would love to see you there. Haha, Joy Deep, that is awesome. I'll do a whole Market Minds tomorrow on what the reward is. That is awesome. SnowX, way to go. And Gene Monaco is here. Gene, you coming to Vegas? Well, you might if you win this, but Gene is here. Way to go. Way to go. GLD is still going down here, guys. It is it's going to be time for a reversal here. I'm going to look for a reversal here once we finish with Market Minds here. All right, everybody. Appreciate all of you. As always, we will see you tomorrow on Friday to wrap up a busy week. Get ready because earnings start next week. Ruben, there is a video about Vegas. Before I hop off here, let me put this link up here. If you follow that link, that'll give you info and a video about it. All right, everybody. Thank you. We'll see you tomorrow. Go Cubs, go.